So here we are. This is an overview. Again, we talked up to this point about the general ledger, and that's where the chart of accounts is. That's where all the transactions are stored. But here's sort of an overview of many of the standard parts of an accounting system. And if the general ledger is the heart of the system, we can think of the lower line where you see accounts payable and purchase orders is sort of like the arteries. That's where money flows out of the general ledger, and the top line, the accounts receivable and the sales orders, where we're going to see money flows into the general ledger. And then we'll eventually talk about the two in between, the payroll and inventory, and how they contribute to the system. So with that, we'll just begin. We'll start with the bottom row, the accounts payable. The accounts payable module, one of the two modules that feed most of the financial transactions to the general ledger, is fortunately a very simple module. It serves one function, that is to pay bills. So a couple things about it are worth knowing, though, or understanding. First of all, it is the place, the repository where your vendor information is stored. And then its function is it gets bills, records bills from vendors. In an accounts payable system, they're called vouchers, as in vouchers for payment. So it records these vouchers for payment, then it pays them by writing a check or recording an electronic transfer. And that's it. That's its functionality. Now, one complication, slight complication, is introduced here compared to, say, your personal situation. Let's say you're the manager in charge of accounts payable, and you get an electric bill on the 20th of this month, and it's due on the 15th of next month. So what do? You recall in the rent expense, we simply entered a transaction against rent and against cash, and that's how we recorded it. But in the real world, like this, we got the bill on the 20th of this month, and it's not due till the 15th of next month. So there's two things you could do. You could just pay it today, and that certainly wouldn't be wrong, and it would be like our rent transaction we showed before. But you're the manager, you're not the owner. Well, you might be, but let's assume you're not the owner. Let's say you're in a municipality. The owners are really the taxpayers. Now, you got a bill on the 20th. It's not due to the 15th of next month, and you paid it right away. And that says to the owner that you're not managing his cash very well, or her cash very well, or their cash very well. And so you don't want to get them upset. So your other alternative might be to just stick it in a drawer and wait till the 14th of next month and then pay it. And that certainly would be a better way of handling cash flow, but there's a problem with that. Let's say at the end of the month they look at those financial statements we've been talking about, and you'll notice there's nothing on there about this electric bill. They have this, we'll say, $100 electric bill in a drawer, and they may have a bunch of bills now you've shoved in the drawer that aren't due until next month, that aren't on the financial statement. And that introduces a problem of transparency. It says your financial statements aren't really accurate. They're not transparently showing you what's going on. It would be nice if they could show that you have bills waiting to get paid. And that is the additional concept of accounts payable. It actually introduces a new account number into the chart of accounts, and it's a liability account, much like our loan was. And you may not be surprised, that liability account is typically called accounts payable. So you have this accounts payable account. What do you do with it? Back to our function here in the picture, when you enter a bill, the accounts payable system wants to send a transaction to the general ledger recording that bill. And so it does. But the transaction now hits, like our rent expense did earlier, it hits an expense account, our electric expense, but as a debit, because that's a debit account and it's increasing. The credit, though, is to our new liability account, accounts payable. So when a bill is recorded as a voucher, it generates a transaction with the expense account and the accounts payable account. This over here, by the way, is sometimes you're paying for inventory, which is an asset account, but for now we'll stick with the majority of accounts payable or expense account. So That's what happens here. So at the end of the month, you now have this $100 liability on your balance sheet called accounts payable. And what that tells the owners is that, well, yeah, I have X amount of money in my cash account, but I have this short-term liability, accounts payable, that's probably going to have to be paid in the next month. So it gives them a better feel for where they stand. Now, given that that's what the entry or the creation of the voucher is, the entering of the bill is, when you actually pay the bill on the 14th of the following month, it fixes that. What it does is it debits that accounts payable liability. It reduces it because it's a credit account. And unfortunately, reality is that it reduces your cash, which is the debit account, by crediting it for that $100. So what you find out is from one month to the next, your accounts payable will go up and down depending on how many new bills you got in, how many old bills you paid. But what it is, it's very transparent. It allows everyone who looks at your financial statements to know what's going on, and it also uses your cash effectively, which gets us to the management considerations as a manager. What should accounts payable do for you, or what should you be looking at? There's two reports of interest in accounts payable. One is the open vouchers report. And what that is, it's a list of the vouchers waiting to get paid. So in our scenario we talked about, as a manager, you might typically pick a day a week, let's just hypothetically say Thursday, where you and the bookkeeper review all the vouchers waiting to be paid, and you simply decide or indicate on that list to release and pay the ones that are due, say, next week, so that the checks get printed and they get paid on time, but you're not paying anything early. So the open vouchers report is a useful listing from the accounts payable. And then secondly, a payments listing itself, or a payments report. It may have various names. Especially in the case of a municipality, you might at your monthly meetings have to show what you paid for the past month, and a payment listing would be good for that. So that's two of the interesting and useful reports from accounts payable. Now, as a manager, though, there's one other aspect of this that we've looked at here that would be useful to you. But a little bit of an explanation first. We're showing you here that when the bills are entered, vouchers are created, general ledger transactions are sent to the general ledger. And similarly, when checks are written, general ledger transactions are sent to the general ledger. Now, these flows of transactions from other modules into the general ledger, these pipelines, so to speak, all have names. In this case here, the transactions created by entering vouchers is referred to as a journal. There's actually 6 of these pipelines. They're referred to as journals, and the one created by vouchers is typically called a purchasing journal. Again, in your system it may have different names, but that's a fairly common one. And similarly, these entries created by the payment of checks is, interestingly, called the cash disbursements or the cash payments journal. Now, why that's important to a manager is because you understand that it is through the accounts payable, through this purchasing journal, that virtually all entries against these expense accounts should occur. So if you see something unusual, you can ask the bookkeeper. All good accounting systems have this ability that you can show them the account number that you're curious about, and they can show you every transaction that hit that account number that month. Now, the first thing I would look at when you saw that, it's called an account activity report typically, is make sure that every transaction against that expense account came from the purchasing journal. So if you see, what you may see is an entry that says the general journal. Now, the general journal is the internal journal to the general ledger. So if they have to make correcting entries in the general ledger, those are recorded as part of the general journal. So the first thing I would look at is, were there any correcting entries, any non-purchasing journal entries, and question them. They could be fine, they could be valid, but they should be explainable. Now, the second thing, if there are no unusual journal entries, they're all from the purchasing journal, then you can simply look at the list of entries there and see if you see any that look out of line. For example, you may have a water account, a utility entry that's high, and when you look at it and ask the bookkeeper, they can actually, for every journal, take you back to the original item that created that transaction, in this case the bill. So they could take you back to, say, a water bill that looks kind of high, and you realize that was a month you had a line break, and so it's not actually incorrect. So anyway, that's probably the more useful management tool from understanding accounts payable. That's where your expenses are coming from. The lower journal, the cash disbursements journal, however, is useful in your checking account, because all the money coming out of the checking account should be due to the cash payments or cash disbursement journal. So again, if you see any unusual withdrawals from the checking account, looking at the checking account detailed activity report, you should examine that and see. Okay, then one final point about accounts payable to wrap it up is that one of the features it has is not only does it have the vendors, those vendors have on them a built-in default account number, or they can. For example, your electric company account, your vendor there would have a position on his account record where you say this is charged to the utility expense account. And then what that does is your bookkeeper, when they open the mail and start entering these bills, they don't have to look at account numbers at all. They simply call up the vendor, the electric company, enter the bill, save it, pick up the next bill, say an insurance bill, call up the vendor, enter the bill. And internally, the accounts payable system will pick the right expense account based on the vendor. Okay, so that's accounts payable. Now let's flip it over and look at the mirror, the opposite account or module, the accounts receivable, where money's coming into your system. Now, accounts receivable, as you can look here, it's almost a mirror image of accounts payable. It contains your customers instead of your vendors, and it's used to create invoices when you bill a customer and record payments when the customer pays you. And it has a similar problem. You might bill a customer on the 20th of this month and they don't pay you till the 15th of next month, using a very same type of example. How do you record it? Well, for accounts receivable, an additional asset account is typically set up in the asset section of the chart of accounts, and believe it or not, it's called accounts receivable typically. And so what happens when you create an invoice for billing a customer, it generates a transaction to the general ledger. You see it on the screen here, much as we did in accounts payable. And it credits the sales account, much like we did when we sold the widget, but instead of cash, it debits that asset account of accounts receivable. And then when the customer pays you, the payment will credit the accounts receivable, lowering it, and debit or increase the cash account. One thing that's different for municipalities that may be used that you may not do in a normal business is that municipalities actually often get their income primarily from taxes, and there is no accounts receivable. They don't know ahead of time. The tax collector brings in daily some deposits, some cash deposits, but you still could use the accounts receivable to make that job easier. Set up each one of your taxes that you record on your income statement as separate revenue accounts. Set them up as fake accounts receivable customers, because on the customer you can put the account, a credit account that goes with that customer. So when you get a deposit from the tax collector, you simply call up the customer, enter it as though it were an invoice, and save it. Most AR systems allow you to record the payment at the same time. So you do that and it'll hit the income account and the cash account, and it'll have no meaningful effect on the accounts receivable account as it's debiting it and crediting it at the same time. So, but for everyone else, though, normally there aren't a variety of income accounts or revenue accounts, and they certainly are rarely based on the customer. So we'll talk about that in one of the future components. But for now, what else is useful about accounts receivable? The reports, there's a customer activity report, just like there is vendors, where you can see how well your customer's going. But the aging report is probably the most significant, and there's aging reports in both accounts receivable and accounts payable. Let me show you an example of an aging report. So here you see an aging report and what's significant about it is, if you notice, this is a mocked up accounts payable aging report. It lists the various vendors, in this case, the open vouchers, and how old they are. And the age is staggered by column. If it's current, if it's over 30 days old, or if it's over 60 days, and again over 90 days. Now that's useful in accounts receivable, just to keep an eye on your customers if they start getting too late. And in this case here, it would be, if this were accounts receivable, that's a fairly active customer, probably a good customer, and you would let them drift a little bit because they give you a lot of business. And down here, this current is customer's current. Now similarly in accounts payable, these, like this one showing here, the vendors, when would you use that? Was if your cash flow is slow, you might hold back on paying some of your invoices, and using a similar logic. The vendors you give a lot of business to, they will tolerate you being a little late on your payment since you're a regular customer. So aging reports are useful for both accounts receivable and for accounts payable. So that's accounts receivable, and accounts payable, as was mentioned, is the largest source of transactions to the general ledger. The next three components we're going to talk about are out of the scope of this primer. We're just bringing them in here because they impact accounts receivable and accounts payable. So let's just touch on them. The first of them, we showed this on that component diagram, is inventory. Now we're showing inventory here for one reason. It's a repository for your parts or for your goods and services. Now, without elaborating on that, you basically set them up, and for each good or service, you can put in a sales account number and a purchase account number, and those will be used, as we'll see in the next two modules. The first of those is the sales order module, and we've all used those. If you've ordered anything online, you've used the sales order entry screen, or if you've used a kiosk in a fast food store to put your order in, that's sales order. And basically what it's doing is it's hooked into accounts receivable and inventory, getting the customer information from accounts receivable, and then for the things you're ordering, it gets the account information, the sales account information from inventory, and it basically prints that. If you get a printed bill with detailed line items, that's coming from a sales order system. So it prints that, and then it creates and sends to accounts receivable the invoice transaction with all the detailed sales account numbers and that. So in a system that's using sales orders system, the accounts receivable is generally only used to capture the payments that are received from the customers. The sales order system is generating for accounts receivable all the invoice information and transaction. And then on the flip side, purchase order is the same way with accounts payable. If you're using a purchase order system, it uses inventory and the vendors from accounts payable to create a purchase order, and then it uses part of the purchase order system will then eventually create the voucher for payment in accounts payable. So that's those three. The last one now is the most complex of them all. It's more complex than all the other modules, yet it's probably the simplest to use, and that's payroll. The hardest thing about payroll is setting up a new employee, but once you put them in with all their information, running the payroll is very efficient, and this is no exaggeration. It takes about a minute an employee to run a payroll. In other words, if you have 10 employees, you walk up and hand the bookkeeper the time slips for 10 employees. 10 minutes later, that bookkeeper should be able to give you the paychecks for signing. Now, why that's impressive, it's not just writing up checks. You see a typical pay stub there in the picture, and every one of these items on a check stub, except the year-to-dates, but every one of the individual numbers on your check stub have to be sent to the general ledger in transactions, and the payroll takes care of that. The clerk simply enters your hours. It's like regular hours, 40, overtime 10. They enter those, and then they print the checks. And once those checks are reviewed and they say okay, the payroll system itself just dumps all the information to the general ledger. And I show it here as 3. In fact, the center one is the payroll journal. And that's where the money on your checks, your cash, when your check is sent to the general ledger as a payroll expense. It also creates 2 other sets of general ledger transactions, but it doesn't do it directly. It feeds them through accounts payable, and that's, for example, your tax deductions that were on your check. Those are all tax liabilities now that the business has to pay, but rather than record it to the GL directly, it will create vouchers for payment in accounts payable. And then the same thing with any miscellaneous deductions like union dues. Those are actually get to the general ledger, but they go through accounts payable. They're set up there, and then they process through accounts payable like any other payable there. So that's the payroll. Complicated but simple to use.